This is Tom Aspray with a Viper Report market wrap video for the week ending July 19th. And what a week it was. Had a little bit for the Bulls and the Bears last week, but that was not surprising given my views as the week started. The better than expected CPI report over a week ago set the stage for what I thought was going to be a rotation out of growth and into value. The question, of course, remains, and still remains, is this a major trend change or a rotation that will be followed by another growth phase? There were the hints last week, most of which were in a better performance technically of some of the value ETFs that we follow. Looking at the NYSE Composite, the broadest measure of the stock market, you can see didn't have a great close. We were down about 0.5% to close at 18,406 after a high of 18,798. So it gave up a lot of the gains. Comparison, the SPY was down 2% and the Qs were down 4%. The Russell small cap was up 1 3/4, but it also closed well off its highs. So do I think this was a false breakout? At this point, no. Why is that? Well, typically it's from the AD lines as well as some of the volume analysis. You can see the stocks only is still lagging. You know, it made a high here and has not yet confirmed this new high. So potential divergence going here, but you know, this is the key sort of support level. Were we to drop back below that moving average and that low, that would support a more bearish outlook. Until that happens, we still go with the fact that the NYSE all AD line, and as we'll look at in a few minutes, the S&P 500 did confirm the recent breakout in prices. As I mentioned a few weeks ago on my expose on divergences, it'll be up at the Viper Report this coming week. You know, if you got to look at the right averages. So everyone had been warning of the divergence between the SPY and the S&P 500 cash and the S&P 500 AD line. Well, as I pointed out, you know, you have to look at the fact that the AD line is also unweighted. So unweighted and unweighted, no real divergences, and now it broke out to the upside, making a new high. So no divergences there. If you look at an unweighted AD line versus a weighted market average, you can often get a skewed look of where the market is heading. NYSE all AD line also made a significant new high early in the week, and you know, is still holding above its moving average. Of course, if we look at the Spider Trust, the weighted Spider Trust, you can see the down gap on Wednesday, and you know, comments over chip sales at the RNC, and you can see the breakout level here, you know, right in that 538, 540 area, along with a pivot and the 50-day moving average 538.71, and you know, that's a pretty good level of support. I wouldn't think we'll test that right away. We could. We're getting close to the Stark band here, so if we get a couple of day bounce and then another push to the downside, we'd get there in a hurry. The S&P 500 AD line, you know, significant new high, back down to the breakout level here. So we'll see if we can see a strong upside reversal. That would be nice. NYSE also well above its breakout level and its EMA, suggesting, you know, that a pullback will be well supported. Much different picture in the Qs. So we had that big drop last week, and you know, I always tell my students, you know, you see a big, you know, not quite an engulfing bar there, but it was close. You know, it's off. Market's going to give you plenty of time. We had a nice 3 days up, you know, after that, and before they pulled the plug, gapping lower here, and you know, we've been testing the Stark equivalent band all the last 3 days of the week, getting down towards the pivot at 470. All right, and then there's stronger support, you know, back here in the 60 area, which I would think would hold. Stop placement, however, would have to be probably under this swing low. AD line still positive after all that selling. Right back down into the breakout level and holding above the EMA. The RS analysis, does suggest that the Qs are not leading right now. Okay, we had a nice strong uptrend here. Back in the late April, early May lows. Was another time to be buying the Qs. Now, it'll take some time before, based on the RS, it'll regain leadership. So you can see that the gap here with the moving average, we could see a bounce in growth, no problem. But before the RS is going to turn around, probably be a couple of weeks. Looking at the retracement levels from this high, you can see that 38.2% is right around 469. There's some support just above that here at 471.5. Then there's also chart support here, correlating to this high and this low, around 460, and then the 50% at 458.29. You see this chart has the nice Stark band things that Jerry developed. So closing above the Stark band here, you can see. Then a doji, time to take some profits here. Time to take some profits here as well after that reversal over a week ago. So now we're getting oversold. So that's not surprising. From the feedback you guys have been giving me, I know you really appreciate the 60-minute analysis and trading signals based on the QQQs as well as the SPY. They've done quite well. This is the longer term 60-minute chart, looking at horizontal levels of support and resistance, as well as the technical studies. Our last longs were established in early June, right around that 461 area, and we took off half a little early just to reduce exposure. Going into last week, we saw some signs that the odds of a sharper setback were high, so we recommended exiting longs on a bounce on Monday, and now we're back to the uptrend here and that initial level of support, this line B. So that's you can see the hourly RSI did break support here before prices broke down, and the OBV also was negative. So there were some signs there that the market was going to correct. If you have any questions about the 60-minute analysis or anything else for that matter, you can always email me at tom@viperreport.com. Interesting data from the 90%. We talked about this last week, and we saw that the buying coming off this last little low has been pretty strong here. So 60% of the S&P stocks were higher, spiked to almost 80% on Tuesday. So far, this has not been too bad selling, not like we saw during the April correction here. Same for the S&P 1500. So it has 400 mid cap, small cap, and large cap, and get down to over 60% there, but doesn't offset this buying at this stage. QQQ also, given the 4% decline for the week, it's you can see we had a couple of 90% down days back in during the April decline. So suggests that though the price damage and looking at some of the big tech leaders was pretty severe, it wasn't necessarily that bad. The big improvement after the CPI report was in the high-low analysis. We monitor this on an ongoing basis, and there's an article on the Viper report about it. But we'd seen this divergence going on for quite a while. Lower highs, that's a sign of not as strong price action here as we were here. What I use for a trigger is to see a spike in the new lows, which we have not gotten at this point. So we kept looking for it, and think the level here was like 116 or something. We got up to like 100. But nice improvement in the new highs last week. Very small number of new lows. So it'll be interesting after this pullback is over if the market does again move higher and above last week's highs, that the new highs also makes a new high. Kind of a mouthful. Nasdaq Composite, even more impressive. You can see this longer term downtrend here, started to kick off here, and really, so this is a sign that the market, the internal market is stronger than the price action. Not much in the way of new lows here. Our benchmark here I think was like 366, and certainly the recent peak was about 212. So it still looks good. Small caps got the story last week. See, this is the IJR. We gapped higher and then off to the races. Spiked to a high of 118.26, closed at 113.73, and I think it's still come back to this 111 area, if not the 109 to 110 area of these two previous peaks. That would correspond with the 20-day EMA, which is just above 110. S&P 600 80 line did confirm the price action, though the volume, unfortunately, on the downside was a little higher than it was on the upside. So I'll be watching that. The OBV did make a marginal new high here and now is back below its moving average. Of course, the signs that the market was vulnerable heading into the week came from a couple of sources. The VIX and VXN analysis, we broke out, before the end of the week here in both the VXN and to a lesser extent the VIX. And then, last week we overcame this resistance level, line A and also in line B, and now it's pretty well extended. If this is a sustainable correction, we would expect to see a pullback here and then another push to another new high in the VIX and the VXN. You can see in April we had a much different pattern. They both diverged, as we were down into support here, and that was a sign to cover our inverse ETFs and look for a rally, which was confirmed earlier in May. There were also warnings from my growth value analysis. This spread, quite interesting. It's been doing a pretty good job here. Back to this little pullback here in April and May, another sharp surge for growth. Heading into this week, it was very extended. So I look at the gap between this high and its moving average, and that was the rubber band was stretched. You can see it was stretched here, but not nearly as stretched as it was last week. So not surprising, that's what happened. It works both ways. This was a value rally, from 2021. You remember some of you made some great money in crude oil during that period. That was it. And we got a bounce here back to the moving average, and then another wave of buying in value and selling in growth. MACDs here are positive. Of course, the million-dollar question is this a rotation that's just going to last for a month or so or less, or is it a change in trend? I wish I had a clear answer for you, but I don't. But I think we'll come up with one. You can see this is a longer-term monthly chart here, and you can see we've broken out. Okay, so that's a positive sign, but it's also very extended. So, clearly this peak right here, if we drop below that low, that will suggest that this is a multi-month, if not a longer term pattern. You can see this chart goes back to the 2000 top, growth peaked, value led all the way down here, and in 2007 value, banks, etc., with the housing crisis, peaked out and growth took over. Like the QQQs were showing really good relative performance in here, and of course that's been the play. And also this last spurt to the upside, in early 2023 I was looking at, well, everyone thought growth was not going to do it. Of course, the current TNJ ETF sector and theme reports will be going out to subscribers later today. This is sort of our list of holdings in the Viper ETF, SPY, FTI, XLK. We're holding just a position for investors, 50%. You can see it gave a 3-day DTS, as did XLC. Same thing, we have a partial position in XLC still. GLD, also, not a full position. It has a daily DTS on Friday. And then the QQQs, daily DTS, as I mentioned earlier, peaked earlier in the week, and then we got a 3-day. So VEA, which is a global participation, has a daily DTS, still holding support. So we'll be watching that one. This is how the sector holdings look. Number of weekly sell signals, Freeport, McFarland, Netflix, etc., AMD, Amazon, and Uber, but also some positive signs here, and that's where I'll be mining for new stock as well as ETF picks for the week ahead. Well, that's all I have for today. As always, please send me your comments and feedback. Tom@ViperReport.com. New articles will be coming up on the Viper Report website next week. I hope you read this critical look at divergences. Divergences are one of the most important tools that a technical analyst has if applied correctly. So, and of course, if you're interested in our services, either the Viper ETF, hot stocks, or mentoring, that's where you'll find more information. Thank you very much for tuning in.